my YouTube channel, The Trading Line. So in this video, we are going to see a wonderful option selling strategy which is called call ratio spread. So mostly we will use this strategy when the underlying stock is bullish. So when the stock is bullish, we can use a lot of bullish strategies which we have already discussed in our videos. Let's say bull call spread or put spread. There are a lot of spreads is there, right? But what is the advantage of doing the call ratio spread is in case if your views goes wrong in other strategies, you will lose something. But in this strategy, if your views goes wrong, you won't lose anything. Okay. In case if your view is right, you can able to collect the maximum profit. You will lose when your view is terribly right. So to discuss the strategy, I'm going to take this stock Adani Enterprises. So before applying any strategies, what you have to do is the first thing you have to do is you have to analyze the stock first. Okay, for that analysis, I have taken the weekly chart of Adani Enterprises, so you can clearly see that this is in bullish trend. Okay, so a high formed and then lower high, and then again high formed and lower high, and now again a high formed. Now it is trading out of these ranges. We don't know whether this is the lower high or it is going to break down again. That's we don't know. But as per the overall trend, what we decided that is the stock is going to move higher. So that is our analysis as of now. So in case if the market is going to crack down, then in case if we are going to implement the normal strategies like bull call spread, we are going to lose something. To avoid that, you can use the ratio spread. So ratio spread is nothing but you have to buy one call option or any of the call options. So you are going to buy some call option. Okay, again you are going to sell out of the money put option to collect the same premium which I have sold here. For example, in case if you are going to buy a call option for 100 rupees, then by selling two lots of call option which is trading in the out of the money for 50 rupees, you are going to collect the 100 rupees premium which you have bought. Okay, in case if you are a risk taker or if you have the good premium with you, you can do 1:3 ratio. That is, in case if you are going to sell it for 150, then you can sell out of the money call option which is trading for 50 rupees, and you can sell the three lots so that you will collect the same premium which you have already bought. Like that, it will keep on increasing. So the most used or suggested method to do the ratio spread is you can go up to 1:2 or 1:3. So that is the maximum thing you can do. So if you are going if it goes beyond that, that means that you are taking too much of risk. So in case if you have good margin, also don't need to do that, because in case if the views goes wrong, you can do a lot of adjustments to come out of the trade with good profit. Okay, now we are going to shift this to the lower time frame. So I'm going for the day chart now. So in the day chart, first thing you have to do is mark the major resistance and support levels, and this is the immediate resistance to this level now, and then this is the immediate resistance. So you can clearly see that this level was acting as a good resistance before, and from there only the market cracked down, and from there it came again to this places. So once this breakout happened, it went up to this level, and from there I think this crash is due to the corona fear. Okay, so now the market is again in the same level. Okay, we don't know whether it will get retraced from here or it is going to break this level, this resistance, and again going to touch this level. So in this kind of scenario, what you have to do is you can implement the call ratio spread. So I will tell you how to implement the call ratio spread using Sensible. Okay, so let's go to the Sensible. So this is Adani Enterprises. Go to build custom strategy. So what I'm going to, so I'm going to choose the current expiry, that is 25th Jan. I'm going to buy 3,850 call option. So the premium is work out to be around 148 rupees. So let's consider this 150. So what I'm going to do is I'm going to sell three lots of 4,100 call option to collect the same premium. So if you do like that, this is how your payoff chart will look like. So in case if tomorrow there is some bad news happen, and in case if the market is again going to crack down, what will happen is you won't lose anything. So that is how this strategy works. So in case if you are going to do bull call spread, then you will lose something, but here you won't lose anything. Okay, so even the market goes to zero, you won't lose anything. Okay, uh, to be frank, you will get some good profit also. Okay, on the expiry, if the market is trading below the level which like this, then you are going to collect some premium here. Okay, you can make up to 4 to 5,000 profit. But in case your view is wrong and the market is going to touch the previous resistance level, that let's say 4,100, like that, then you are going to get your maximum profit when the market is going to reach this strike price 4,100. In case if it is go beyond that, but here you can see, right, your break even is 4,234. So that is, I think that's a new high. It's up to this level. Okay, so up to this level you are safe. So once the market is going to break this level, then only here your position is going to bleed. So for that also we have some strategies. Okay, so those adjustments and everything we will see in the upcoming videos. Up to now, just be clear with this strategy. Okay, guys, so this is how we should analyze the stock, and based on that, we have to form the strategy. I hope you guys can able to understand this, and this video is very useful to you guys. Thanks for watching.